Hello and welcome to NDTV Profit. You're watching IPO Adda, and my company in focus today is Northern Arc Capital. It's an NBFC which is primarily involved in lending to MSMEs, microfinance institutions, consumer finance, among other auto finance and affordable housing. And joining me today is Ashish Mehrotra, who's the managing director and CEO of the company. The company's IPO is opening on September 16th. It closes on 19th. 249 to 263 is the price band. It's a fresh issue of 500 crores and OFS of 277 crores. So the total size of the IPO is 777 crores, and the company is valued at a little over 4,240 crores at the upper end of the price band. Ashish, thank you very much for joining us on NDTV Profit. To begin with, take us through your business model. You are more concentrated on the eastern part of the country and more into MSMEs and microfinance institutions. So give us your business model.
Hey, thank you very much, Sajid. Thank you for giving us the time, and thank you for being there on your show. Let me just spend a couple of minutes walking through what we do at Northern Arc. Northern Arc was established about 15 years ago with an objective to ensure seamless flow of credit to the underserved households and individuals. Over the years, we developed a deep domain expertise across our focus sectors. We operate in 6 focus sectors. MSME is primarily our biggest sector, followed by, MFI, consumer finance, affordable housing, vehicle finance, agricultural supply chain. We move sizable amount of credit across the sectors. Our approach to credit is multi-channel. We lend. We both as an intermediate retail financer and direct to customer. More importantly, we also use that opportunity to create sticky fee income by providing credit solutions to our originators. And we also augment that by investing through our fund management business known as Northern Arc Investment Managers. So we are a very diversified financial services business, consistently profitable year after year and generating significant returns. So we're happy to be talking to you today.
You're raising 500 odd crores. Can you take us through the use of proceeds for these 500 crores?
The use of proceeds will essentially be towards the expansion and growth of the business. Our business has been growing at about 30% CAGR year on year. And we believe that this initial public offering, essentially of the primary of 500 crores, will, with leverage, allow us to provide sufficient growth capital for next 2 to 3 years. And that's why the big focus is to raise a sizable amount of primary and supported by a very small amount of OFS.
Your asset under management is growing at 18% CAGR for last 3 years. The 500 crores that you're raising, is it enough for your growth capital for the next couple of years, or will you have to come back to the market?
Okay. No, I think it will give us sufficient growth capital, but just to correct, our balance sheet growth is about 30% plus. Our balance sheet is growing at about 31% year on year for the last 3 years. Our income growth is actually higher, it's about 42%. And you'll see the profit growth is even better than that. Because we are diversified financial services across sectors, we are able to lever the tailwinds of the sector and provide meaningful returns to our and provide meaningful solutions to our customers.
I was looking at your NIMs, 8.4%.
Essentially catering to the diversified need. Yeah.
Yeah, 8.4% your NIMs for FY.
We have a very healthy NIM.
Yeah. So my question was that
Our NIM is pretty healthy. NIM has grown significantly.
So the question was basically, it's grown from 6.3 to 8.4% in FY24. Is there a particular reason why it has grown so aggressively? And is there given the fact that your floating rate borrowings is around 45% odd?
So I think the way to look at our business, as I said, we are diversified across the focus sectors where we operate. where the industry growth rate is about 12 to 13%, about 2% of GDP. The NBFC growth is slightly higher. Our growth is about 30% year on year. The way to look at it is that strategically we follow four-pronged approach. A, we want to be a leading platform in providing credit solutions to our originating partners and to investors, provide them asset quality where they can invest in. B, we set out a journey to ensure we continue to broad base the franchise, granularize the risk. C, end of the day, what we really value is looking at risk on a first principle basis. Culture, what got us here, we deeply focused in providing the credit solution. We would have impacted close to 100 million lives. And D, we are eventually data and a digital company. As we go about continue to broad base the franchise, and building direct to customer business, that's resulting in the expansion of NIM from about 5.6% about 3 years ago to about 8.3%. And we believe that our strategy to build this over the years will continue to create a meaningful franchise and create the value for all the people and part of the ecosystem where we operate.
You lend to some of the parts of the country where MSMEs are at risk in terms of operations, Assam, Odisha, Northeast area, and MSME account for nearly 40% of your AUM. How do you manage that risk, and have you factored in all the risk coming in from that segment?
Actually, if you look at it, and that's a very interesting question. End of the day, like I said, our mission is to ensure seamless flow of credit to the underserved businesses and households. And we, over a period of time, develop a deep domain expertise, and that's really helps us to provide the credit solution at the size and scale. Our portfolio is spread over 640 districts, i.e. about 80% of India's geography. More importantly, our approach to risk is fairly comprehensive, the way we look at it. And we have time-tested risk model, 30-plus risk models we use. And we learn on a monthly basis, on a quarterly basis when we refresh our portfolios. So if you look at it, my GNPA is less than 50 basis point and net credit cost is about less than 10 basis point. What really differentiates us is in terms of our approach to risk, not only our tech stack, which is a Nimbus platform, the NPOS on-lending and co-lending platform, but also more importantly, our deep data analytics, given we have 35 million loan data point with time series of loan performance data that enables and ensures that our risk models are tested again and again. And it's coupled with data science capability is our unique proposition. The way we look at the risk is essentially how the loans are being originated on ground, how those loans are getting serviced, how those loans are getting underwritten, and how those loans are getting sunset. We cover almost 30% of our geographic footprint through an independent risk monitoring team, and that ensures that we get the touch and feel of the ground, and that we do full 360-degree curve, that we not only go to the branches of our originating partners and our own branches to look at how the risk is being underwritten and how risk has been serviced, but also then we close loop by talking to few of the customers. That gives us a massive insight of what's happening and enables us to take the right decision at the right point of time. And we have a strong governance process around it. And that ensures that our credit cost continues to be significantly superior over a period of time. And if you look at it, it tells you the numbers, tells you the GNP of less than 50 basis point and net credit cost of less than 10 basis point. The quality of the franchise is very, very robust. Risk is a core to us, and we look at it on a first principle basis. And that's why whether it's in our lending business, whether it's in a placement business or in a fund management business, that really differentiates us across the ecosystem where we operate, coupled with our deep sectoral expertise.
Can you give me a sense of how the MSME segment is now doing? Because what we hear is murmurs about stress in this segment and high financing costs that these entities are facing. Is there a stress that you see emerging in this segment, given the fact that they have a higher financing cost to bear, and and not able to grow at the speed as envisaged?
Actually, the way to look at it, both MSME and the households, we grossly underserved with regards to the credit needs. If you look at it, about 400 million, about 50% of the adult population in India does not have access to formal credit. And the same holds true for the small businesses. As long as you have a robust underwriting and you are able to manage the risk, onboarding of processing, underwriting, scorecards, and your personal discussions with customers enables that you are able to identify the right set of cohort of customers to lend money to, and then create value for them so that they continue to stick with you and provide the credit solutions. I think that's the core to what we do. Sectorally, you can see some bit of blips, but in our own balance sheet, like I said, the GNPAs is only 50 basis point and net credit cost is about 10 basis point, tells you that we are significantly ahead and are far more proactive in understanding of risk and managing of risk.
Yeah, the reason I was asking was that you lend to two segments, which is MSMEs and MFIs, both accounting for, if I'm not wrong, roughly around 63-64% of your AUM, and it is a high risk market. So how do you manage your risk into these two segments? Of course, consumer finance is another one which is emerging for you. 26% of your AUM goes to that, but these two, MSMEs and MFIs, microfinance.
Sanjeev, the way to look at it, we are a diversified financial services business. This means we are able to, our portfolio spread across 6 sectors where we operate. MSME is predominantly the large one for us, coupled with the consumer finance, the MFI, the affordable housing, vehicle finance, and agri supply chain. Given that the quality of the portfolio we have and the diversification across the book, both in terms of balance sheet and our gross transaction values, enables us to manage the risk far more proactively. The GNPS gives you a good story on the quality of the franchise. Correct? If your GNPA at this size and scale is about 50 basis point or less than 50 basis point, and net NPA of 10 basis point tells you that it's a very high quality franchise. Obviously, in the sectorally, you will see some amount of headwinds. As long as you are proactive in managing those headwinds and you're able to pretty sharp with your risk scorecards and underwriting models, you ensure that you're able to have a way lesser amount of adverse select coming into your book, and that creates the quality of the business. Actually, if you look at it historically, our numbers will be significantly better with regards to the credit performance on our balance sheet.
Your net interest margin at 8.4% for FY24. How do you see that moving? Do you see enough room for expansion of these margins going forward?
I think as we bring a strategy into play, and a strategy, like I said, A, be a leading platform in providing, in enabling the flow of credit, B, continue to broad base the franchise, granularize. This means build a lot more direct to customer business. C is culture, values, cost consciousness, credit first principle. D is data and digital. That ensures, as long as we continue to build the franchise around it, I think the NIM should continue to expand from where it is. We are very conscious of the product and services we offer, both as an intermediate financier and as direct to customer. And our sense is, coupled with our data and tech capabilities, we run two most sophisticated technology platforms. One is known as Nimbus, which enables the seamless flow of credit on a B2B side. And the second is customer to an originator to us is called NPOS, which is on lending and co-lending platforms. We process anywhere between 20 to 25,000 loans a day, real-time, underwritten, real-time, customer attested, KYC, penny drop to validate the account and disburse, and then the repayment through the national. So we run pretty sophisticated technology platform, which we also offer as solution to some of our investors and banks. And then our own scorecards, which is known as New Scores, which enables the institution and us to bring our credit policy at play, essentially asking for most difficult but simple of all question, i.e. whom to lend, Second, how much to lend, what price to lend, and in case you do all of this, what will be our probability of default. It helps us to bring our risk policy at play. And I think as we bring all of these pieces together, we should see a continued growth from the way our trajectory has been over the last 3 years in a very calibrated manner, ensuring the flow of credit to the underserved sectors, which is essentially the high growth sectors in India. That these sectors where we operate comprises almost 40% of India's credit. And these sectors are growing significantly faster. I think that gives us a massive edge for us to play and continue to grow in a very responsible manner.
Your average cost of borrowing was around 9.2%, and it was 8.8 the previous fiscal. Do you see that stabilizing at this level, and because of the current fundraise, it should come down for you in FY 25-26?
Yeah, I think so. And let me take a stab at it. Actually, our average borrowing cost has come off from where we were 3 or 4 years ago by almost 180 basis point. But the way to look at it is the repo rate moved up by 240 basis point over the last year and a half. Our cost has only moved by about 40 basis point. The second most important piece, we are AA rated. We were one of the few companies who got rating upgrade just basis the performance of our book and the company's performance. That means over a period of time, we should see, also going back to your previous question on NIM, that the borrowing cost should continue to come off. The third, I think the most important piece, which is very unique to us and gives us a massive tailwind vis-a-vis other player, given that we are focused towards the flow of credit to these underserved sectors, essentially addressing the needs of small businesses and the household who have lesser access to credit. We are able to attract large part of our borrowing comes from global multilaterals, or what is known as DFIs, and domestic DFIs that constitute almost 20 to 25% of our borrowing. This means we are able to borrow for long at a better price, and also gives us a positive mismatches in our ALM. The fourth important piece to bring it out, given that we have access to large amount of global multilaterals wanting to participate in India growth and enabling the flow of credit where it is required in the high impact sectors. We also use that opportunity to find credit solution for our other originating partners. And that means we are a massive ecosystem catalyst in ensuring the flow of credit to these sectors in a very responsible manner, day after day, month after month, year after year. And that gives us an edge over most of the other players in the market, because we have a very diversified borrowing profile if you compare it to any other peer. So about 60% or 65% is essentially from the banks and from the local banks between PSUs and private sector, and about 20% coming from our global multilaterals and DFIs in India, and then balance to other routes. So we have a very strong liability franchise, and that is essentially the fuel for us to be confident of the growth of this business.
So do you see, as part of your diversification, you're increasing your exposure to offshore financial institutions, because currently it's around 16%. You see that going up going forward?
I think so. Obviously, given the impact we create in the sectors where we focus, like I said, we've impacted about 100 million lives in India. We are a gateway for a lot of these multilaterals to participate. And if you look at our own book, you have FMO. We are their largest obligor in Asia. It's a Dutch impact finance, whether it's IFC, whether it's USDFC. Most of the global multilaterals are there. And we use that not only for ourselves, given our mission is to ensure flow of credit, we also use that opportunity to provide access to other players in the sectors. And that creates a very sticky fee income. More importantly, helps us to stay true to our purpose of enabling flow of credit to the underserved sectors in a very efficient, scalable, and a responsible manner. To me, that's a big differentiation for us. We are a very unique franchise, if you look at it, not only addressing the need of the credit in India or for the Viksit Bharat, using that opportunity and using our data capabilities, our tech, providing equivalent amount of credit solution, if not more, to other originators. As you see, our placement business is almost $1.5 billion worth of volume we do. And then the fund management, which essentially all focus towards the same thing. So we run a very powerful flywheel in ensuring the flow of credit to these underserved sectors and use the same first principle basis on risk and the same technology stacks for enabling the flow of credit. And then that credit can essentially come on our balance sheet, can go to other investors, and our funds business can also participate in the same credit. So we run a very powerful flywheel, and this is how the network effects for us comes into play.
My final question to you is on the provision coverage ratio. It's at 82.6% for you. You have increased it over the last couple of years. Do you see a gradual increase coming in for provision coverage ratio going forward as you expand on an aggressive rate?
I think, we've always been very prudent, and like I said earlier, we look at the risk on a first principle basis. 82%, to my mind, is probably the healthiest coverage for the provision which we have. But given that we have significantly lower GNPA and the net NPAs to what I spoke about, 50 basis point and 10 basis point, we ensure we are efficiently prudent and cautious to ensure we have sufficient coverage of our book.
Ashish, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit. Your IPO is opening on September 16th and closes on 19th. Price between 249 and 263 per share. It's a fresh issue of 500 crores and an OFS of 277 crores. That values the company at nearly 4,243 crores at the upper end of the price band. Thank you for watching and being on NDTV Profit.